Hey everyone, thanks for coming back for another Money Not Math conversation. I know it's been a while since I made my last one, so I apologize for that. But I do appreciate you joining me for today's Money Not Math conversation. In addition to Money Not Math, I also want to mention that, as you can see, I'm wearing my Gophers gear because it's Saturday, December 19th, college game day, and the Gophers play Wisconsin for the Axe today. And obviously, I'm a huge Gopher fan, so I'm just hoping they don't flop today. I know I'm a huge PJ Fleck believer. But it would be it's been a very weird year. So if you're a college football fan, you know the Gophers have been struggling with COVID and injuries and all that different stuff, and Rashad Bateman leaving and things like that. So, anyways, besides college football, let's get back into the money conversation that we'll be having today. For today's conversation, I'm going to be reading through and kind of analyzing an article from thinkadvisor.com titled David Blankett's, or Blanchett's, not really sure how to say his name, 6 Predictions for Retirement Planning in 2021. So David Blanchett or Blanchett is, he is the, let me make sure here, he is the head of retirement research for Morningstar Investment Management LLC. For those who aren't aware, Morningstar is one of, if not the most popular stock and mutual fund analysis site as far as providing supposedly independent reviews of different stocks and their strength, things like that. So his first prediction, the search for yield will continue. He says today's low expected returns, especially for fixed income investments, can have a pronounced negative effect on portfolio outcomes. Oh, excuse me, I got an eyelash in my eye or something. So I guess I'll just keep crying and blinking through this video. While retirement research has largely focused on equity-related sequence risk, earning a negative real rate of return after fees, inflation, and taxes for an extended period in early retirement can have similar negative effects on retirement outcomes. While some advisors are increasing risk to try and juice portfolios, this is perhaps even riskier, since it has the potential to make outcomes even worse if we experience a pronounced correction. New products such as fixed rate annuities might be worth considering as a part of a retiree portfolio allocation to pick up some yield for the fixed part of a portfolio. All right, so a lot to unpack here. So first thing I want to highlight is what he said about real rate of returns. All right, so you'll notice oftentimes when it comes to investment companies, marketing, and things like that, they love to use historical average rate of returns for futuristic actual rate of return projections, which we know is not actually a fair way to predict how your money's going to grow, but it does make it look really sexy. All right, so we have to be really clear on what the real rate of return of your money actually is when we consider the difference between actual rate of return and average rate of return. So when the market, the market's a roller coaster, right? So when it fluctuates, we have to understand how that impacts your real rate of return. We also have to understand how fees impact your real rate of return, right? So if you're paying an average of 1% of fee a year, we have to take that into account when it comes to your growth. We can't just assume whatever the S&P 500's rate of return has been, that's what you're going to get, because you still have to pay fees and things like that. Inflation, right? So if inflation is 3% and you only got, let's say, 4% rate of return, then you paid your fees, so you're down to 3. Then inflation was 3. Basically, your money just maintained its buying power. Taxes is a huge part of planning. Not only the taxes you're going to feel today, but also the taxes you're going to feel in retirement. For anyone who's worked with me or had a conversation with me, that is the primary area that my team focuses on, because we believe it's a very overlooked portion of financial planning. If your money grows to $1 million, but it's all tax deferred, and you end up having to pay $400,000 in retirement to the IRS, well, unfortunately, that cut your rate of return that you thought you had by 40%. You only got to keep $600,000. Plus the taxable income in retirement affects your Social Security taxes, plus it affects your Medicare costs. So it's extremely important to be aware of where you put your money today and how it's going to be affected by taxes, not only this year, but in retirement is almost more important in my opinion. The second thing, and then he follows that up by saying, some advisors are increasing risk to try and juice portfolios. So what he means by this is that for many people that they get to retirement, if you don't have enough money, or if you didn't hit quite your savings and wealth accumulation goals, you might end up having to take more risk in retirement to try to and create more retirement income. The problem with introducing more risk or maintaining more risk in your retirement portfolio in order to get a higher return is what? Well, on good years, great. You have higher return, got more retirement income. But on bad years, now you're going to lose more money. This is extremely important at times like this when we just had an election, right? The market's at one of the highest points it's ever been. So people are feeling good. But once Joe Biden gets into office and once some different tax changes happen or different economical changes or world stage changes happen, what if the market corrects? We haven't had a major correction since 2008, unless you count the brief one we had in the beginning of 2020, but it came back. What's that going to look like if you're near or in retirement? How is that going to affect your retirement planning? How do you have your retirement plan set up if taxes go up and the market goes down? All right, that is one of the most important questions that I hope you and your advisor have answered, is what happens to your retirement plan if taxes go up and the market goes down, or the market goes down. It's extremely important to understand that. So the worst thing one of the worst things that can happen to your retirement portfolio and your retirement planning is if you have a huge drop early in retirement, and then you're also pulling money out at the same time because we don't have our money diversified enough to have other streams of income. All right, so I think I unpacked most of what happened, what he talks about there, but it's extremely important to be aware of that. And when he's talking about fixed rate annuities and things like that, is annuities are an option in order to build basically your own pension. So build a guaranteed income for life that you can't outlive, depending on how they're built. All right, number 2, the robos will keep rising. How comfortable were Americans with conducting their business online pre-COVID, especially older Americans? I would say kind of, would be a little generous. Now, though, many Americans have had to adapt to an environment of online interaction. This could have interesting long-term implications for the financial planning profession. While robos are often thought to be geared more toward younger investors, like those pesky millennials, as retirees become more comfortable using online tools, they may be more willing to try robo-like advice models, especially if they are priced well below traditional advisors. By no means am I suggesting that the traditional advisor model is dead. This could be a good thing for some traditional advisors that have a strong online presence around retirement planning options. So not a whole lot to say there. The biggest thing I would say is, the internet's a great place, or online robots are a great place to look for information, but how do you know that information is really personalized for you, right? I mean, if you place a value of having someone live individually analyzing your position, your family background, your financial goals, and really getting to know you as a person, not just looking at you as a spreadsheet, that's where the financial advisor is always going to have its place. And I hope to always make an impact for my clients. If you just want to be a spreadsheet to some computer out there, and you think you could do it yourself better than someone who studies this stuff on a daily basis, then that's where online robos might be the best option for you. Neither is really right or wrong, I guess. It's really just a personal choice. You just have to be, aware of the risks and benefits of both sides. Number 3, people will likely have to work longer, even if they don't want to. Well, I think that prediction's kind of has probably been going on for a while, but while stock markets have been doing relatively well recently, retiring into an environment where real bond yields are expected to be negative for the foreseeable future has important long-term implications. While the percentage of older Americans staying in the workforce has been on the rise for the past few decades, any type of updated financial projection incorporating the possibility of lower returns is likely to be a little scary for retirees. I understand that lots of people don't want to work longer, but most Americans aren't exactly well prepared for retirement, and delaying retirement is one of the best ways to improve retirement readiness. So what he's kind of saying there is that due to low interest and low yielding bond markets, it's really, really affecting the production of not only bond portfolios, but mutual fund portfolios and other areas of the financial sector that help maintain long-term retirement income for your planning. So that's something to keep in mind, and how that affects going forward is also something to keep in mind. And the projections of mutual funds moving forward is a lot lower than the historical averages that we've been seeing for the people that are writing these analysis. With that also, it's important to be aware of the fact that due to the fact that we're living longer in retirement. All right, so 50 years ago, people would, their retirements were a lot shorter, so they didn't have to have their money last as long. Well, now we're living longer in retirement, so we have to build strategies that make sure our income last long, just as long as or longer than our life does. We don't want to be in a position where we're alive longer than our money lasts, right? So those are just a couple of things that's really, it's a really interesting complex that's coming in through retirement planning advisors right now, is that we're looking at negative bond markets while we're living longer. So it's becoming a challenge in order to make sure your money lasts long enough in retirement if you weren't properly or prepared or having extra funds available. Number 4, an increased focus on liabilities. Most retirees are retiring with debt, and therefore managing liabilities is going to become more important. Many advisors focus too much time on the asset part of the client balance sheet and not enough time ensuring the liabilities are equally efficient. Considering non-traditional products to fund retirement, such as reverse mortgages, may also become more important if expected returns remain low well into the future. So 3 things on this I would say is, first, it's extremely important to understand the difference between compounding versus amortizing interest. All right, compounding interest is how much potential you're going to grow your money and your wealth to create income in retirement. Amortizing interest is how much interest you're going to lose to the debts that you have on your balance sheet, right? So depending on what your runway is until you retire, compounding versus amortizing can have drastically different outcomes. So if you're much younger, almost any analysis we run, compounding interest is going to way outweigh the lost interest of amortizing on your debts. But if you're closer to retirement, that may not be true. The second thing to be aware of with that is it's not necessarily a bad thing to have debt as long as your cash flow can maintain it and afford it. The biggest argument, if you're a wealth creator, of having debt is the ability to reallocate those funds elsewhere to create wealth. But the problem is that we have to make sure that our cash flow and our budget can handle the debt. If it can't, that's where we can get in really big trouble, especially when we're entering retirement, where we're turning off our income generating tool, which is ourselves going to work. And the third thing they talk about here is reverse mortgages. It's not that, it historically hasn't been that popular of a tool, but it's an important one to be aware of. So sorry for that, my phone just rang there, but if you are in need of, the way reverse mortgages work in a very general sense, I'm not a reverse mortgage salesman, so I can't claim to be an expert, so don't quote me on this necessarily, but generally speaking, how reverse mortgages work is that when you buy a house, right, you get to move in. You don't actually own the house until you've paid off the bank, right? So whether you're 15 or 30-year mortgage, you're paying the bank but while living in the house. Well, in retirement, what some banks will allow you to do is reverse that, where they'll actually start paying you to live while you live in your house, with the agreement that once you pass away, they get the house to then turn and flip and sell themselves to take the profits. Right, so it's just, and with that, it's a tax-free way of generating income, just like you don't pay taxes on your mortgage. So if you're looking for more cash flow in retirement and are running out of options to do so, and aren't adamant on the idea that you have to pass your home on to your children, reverse mortgages can be a really beneficial tool to utilize. Number 5, the search for an easy button will continue despite the fact that there isn't one. Don't get me wrong, I actually like the rule of thumb, like the 4% rule, because they simplify topics that the public is not going to be able to grasp in their entirety. But rules of thumb tend to apply to relatively narrow domains and aren't perfect by definition. From my perspective, rules of thumb serve as the beginning of a conversation about a topic that is further personalized based on that client's situation. While I'd like to think there's an easy button out there for retirement, I don't think there is one. People need help, and I think there's no replacing the advice you can get from an experienced advisor. So I completely agree with him here. First, he talks about the 4% rule. For people who don't know that, for the longest time, it was assumed that you could take 4% of your total market-driven assets, like your 401k, on an annual basis as income in retirement. So with $1 million, you can pull up $40,000 a year, and you shouldn't run out of money before you pass away. Unfortunately, world-renowned economists like Wade Pfau, who study this stuff all the time, say that 4% rule is really closer to 2.8% now. So if you had $1 million, you can only pull out $28,000 a year. But what's really important to be aware of, and this goes back to the online robo advisors conversation that we talked about earlier, is the fact that no one rule or one plan fits everyone, right? So it's really important to have personalized plans built for you based off your financial background, your financial goals, and your financial situation. because no rule of thumb there's no such thing as a cookie cutter plan, which is why rules of thumb and like books that are written that are supposedly applied to everyone really grind my gears sometimes. And last but not least, maybe there isn't a last one. I think there is. Number 6. All right, annuities, especially those focused on guaranteed income, will continue to suffer. More accumulation-focused annuities, such as fixed-rate annuities, might do well given an increased level of risk aversion and desire for safe return. When you ask academics about annuities, the focus is usually the more traditional benefit, guaranteed income. Interest in annuities appears to be on the rise, especially given the uptick of fee-only options out there. But low interest rates mean low payouts, and that makes the annuity decision a difficult one. This is one I hope I get wrong. So I'm not going to really dive too deep into this. If you're interested in learning more about annuities, I think it'd be better to have a one-on-one conversation based off your current situation rather than throwing out a bunch of hypotheticals. But basically his point is he believes risk averted annuities that grow with safe return will become more popular, but he believes that guaranteed fixed income annuities will become less popular due to lower interest rates and things like that. So again, I hope today's Money Not Math conversation talking about David Blanchett's 6 predictions for retirement planning in 2021 was helpful for you. I hope the Gophers win today. Sky Yuma, row the boat, go Gophers. And I hope the Vikings win tomorrow, keep their playoff hopes alive. Thank you so much for taking the time to connect with me today, whether you watch today on Saturday or you watch in the future or listen. I really appreciate your time, and I appreciate it even more if you're willing to take the time to like, share, or comment on my posts, and even better, reach out to me to let me know what you think, or if you have any specific questions or requests for future conversations, that would be great. All right, thanks again. I hope you have a great day. Bye.